Hey, my name is Josh Walker. I'm one of the owners of Arete Investing. Today, we're going to talk about what is a syndicated investment. We talk about syndicated investments a lot. We are huge advocates for investing in syndications in general. That's why we created Arete Investing. We wanted to give more people access to syndicated deals that they may not have otherwise had access to. But let's talk about what it is. And we'll start with why you should care and know that there's a chance that you shouldn't. Um, if you love the stock market, if you trust the returns that you believe you can get in the long term from the stock market, if you love the idea of building a stockpile of money that's invested in mutual funds and index funds and IRAs and 401ks, if you're a huge proponent of things like the 4% rule, where you build up a retirement nest egg and peel off 4% each year in retirement and hope that it lasts until you die. If you generally are okay with other people being in control, a whole lot of control of your financial future, if you're okay with paying taxes, you're going to invest money now, and maybe it can be tax deferred, but you're just gonna pay the taxes when you pull it out and trust that you're going to be in a lower tax bracket. If all those things generally fit into your core beliefs about investing, then this is 100% not for you. But if you believe that there is a better way, if you get frustrated with all of those things and truly believe that there is a better way than the traditional IRA, 401k investing world, then keep listening. About 7 years ago, I found myself in that situation. All I really knew when I heard you should invest money, all I knew was the stock market. And I think that's the case for a lot of people. And I generally hated the idea of investing any significant amount of money in the stock market. So I started down a path of figuring out a better way. I like the idea of real estate. Um, for all the reasons that a lot of people love real estate, right? I liked the idea of creating cash flow, right? Just getting checks every month or every quarter or whatever that looks like. I liked the idea of appreciation. I knew generally that there were some tax advantages to real estate, but I didn't completely understand them. So I started out, my wife and I started looking at single family rental homes. We live in Norman, Oklahoma. We were looking in and around Norman, Oklahoma. We didn't love the numbers. And the more we dug into it, we quickly came to realize we didn't love the idea of being landlords. My wife probably disliked that idea even more than I did, but I certainly wanted no part of being a landlord. And the co-owner of Arete Investing, Scotty Bryan, introduced me to somebody who knew what syndicated deals were. He said, "You should listen to this guy. He can explain what these are to you." We didn't have enough knowledge to have a reasonable conversation about it. So I went down that path and learned what just the framework of what a syndicated investment is. And I completely fell in love with them and went crazy investing in them. I think I invested in a dozen of them in the first year that I found out about them. And this kind of became trial by fire. I didn't know at all. I understood the framework, but I didn't know what I was doing. So it was an interesting year and has been interesting to see how some of those deals have played out. But I didn't have a trusted mentor to teach me how to evaluate these deals. So I got a lot of these things wrong early on. And so we have dedicated the past 7 years to figuring this thing out and creating a tight, trusted network within this syndication world where we have mentors and we have trusted partners and have personal relationships with a lot of the guys running these types of deals. And the entire purpose of this podcast is to become a trusted resource for other people who want to know this kind of information. So, with that background, let's talk about What's a syndicated deal? What is the definition of a syndicated investment? So it is the pooling of money from multiple investors to purchase an asset with which a business plan is going to be executed and the profits are going to be distributed. At its most basic level, that is what a syndicated deal is. This can be for any type of asset, but to keep it simple, we will focus on multifamily real estate, think apartment complexes. So, what syndicated investments allow is for investors like you and me to participate in larger and potentially more lucrative real estate projects than we would otherwise have the ability to invest in. So, let's talk about who's involved in a syndicated deal. So, you kind of have two sides to it. You have the investors, which are also known as limited partners or LPs. And then you have the sponsor, also known as general partners or GP. So I'll use all of those things interchangeably: sponsor, general partner, GP. It all means the same thing. So let's talk about what a sponsor does. The short answer is they do all of the work, all of the actual work. They find the deal, or the asset. They line up the financing. They take care of all of the legal documents, which are plentiful. They create the business plan. They structure the terms of the deal, and they raise the money. What you do is you do your due diligence on that sponsor and on that deal. And we'll have a whole separate podcast on how to evaluate these deals. But essentially, your piece of it is to invest. That's what you do. These are one of the only truly passive forms of investment. They are so passive that once you are invested in it, if you want to be an active participant, you cannot be, right? You are legally bound to not be a part of that GP, that general partnership or that sponsorship group. So you can argue that there are people that get all hung up on what's passive and what's not, and nothing's truly passive. And yes, you should do all of your due diligence. So it's an active piece to go do all the research that you need to do into that sponsor, into that deal. But as far as investments go on the general spectrum, this is about as passive as it gets. And that's one of the reasons that we love them. We're very, very busy doing other things in our lives and don't want to manage all of these separate types of deals. So these syndications can be, I mentioned, for any type of asset. So there you can invest in apartment complexes, mobile home parks, office buildings, hotels, neighborhood developments, and there are crazy things that you can invest in, which maybe it's your thing, but I would stay away from some of the crazy things. So I've seen the craziest thing I think I've ever seen is where you could invest in somebody's legal fees and potentially share in the proceeds if they win that trial. I've never participated in anything like that and don't advocate that anybody does. We will focus on real estate, specifically multifamily, think apartment complexes, only because it's the easiest thing to understand and it's a good foundation for anyone's understanding of syndicated deals. So let's talk about how these actually work. So, from a practicality standpoint, from a logistical standpoint, the first thing to understand is there's a minimum investment, and that investment is completely up to the sponsor. They can design these deals however they want, but they will have a minimum investment, and they have the flexibility to wiggle on that with different investors. They're in complete control of these deals, and so I've seen them anywhere from $10,000 to $500,000. Our minimum for the deals that we roll out is $25,000. That may change in the future, but for today, it's $25,000. On the whole, most of these types of deals, you can expect a minimum from $50,000 to $100,000. So the second thing to think about, so you've got a minimum investment. You need to understand what a preferred return is, and sometimes that's referred to as a pref. Every deal does not have a preferred return. We like deals that have a preferred return. And so, what a pref is it's the percentage of the profits that go solely to the investors before the sponsors or the general partners receive any percentage of the profits. And so they're typically between 6 and 9%. So that means, say it's 8%. That means that you, as the investor, will receive an 8% return on your investment before the sponsor receives any amount of profits. Now, that doesn't mean they don't get any money. There's typically and should be a management fee. They're doing tons and tons of work. So there's going to be a management fee that's relatively small. That's how they sustain themselves until these reach that threshold where they can take some portion of the profits. But we love this because we love deals with a pref because it even further incentivizes that sponsor to make these that much more profitable. Second thing you need to understand is a waterfall. So essentially, that is the definition of where the money goes, essentially upon a sale, but basically after the pref. So once you have crossed the threshold that is the pref. So again, say it was 8%, there's a predetermined split of the profits, who gets what percentage of the profits above and beyond between the sponsors and the investors. So this is typically between 80-20, with 80 going to the investors, 20 going to the sponsor, and 50-50. So some investors will immediately discount a 50-50 split. They'll see that the split is, everybody would love to see an 80-20 split. Right? 80% is going to the investors, 20% is going to the sponsors. We're going to get, as an investor, that much higher percentage of the profits. So some people will see a 50-50 split and not even look at the rest of the deal. Know that those sponsors, to be able to throw out a 50-50 split and raise the amount of money that they need to raise, they often have an amazing track record if they're going to roll something like that out, and are often very, very worth, very, very worth. That's an interesting way to put it. They're worth continuing to dig into that deal, continuing to see their performance. They may be an outstanding sponsor and be completely justified in that 50-50 split. And I've seen a lot of deals where my ultimate returns were a higher percentage in a 50-50 split than an 80-20 split, because that 50-50 sponsor was amazing at creating value. We'll talk more in the next episode about what is a syndicated investment.